Hey guys, Adam Burns here, bringing it to you on the COVID impact. We're not touching on it too much in today's episode, but we have noticed a lot of impacts on the construction trades throughout COVID. And today's episode is actually sponsored by one of our favorites, John McHugh of McHugh Electric. All of you have been asking who we use for these various trades and who we like in the industry. He is one of the best. So if you're in the Boston market for an electrician, reach out to John McHugh of McHugh Electric and he'll take care of you. Now back to the COVID impact on the real estate market. So my team and I have a ton of experience in various ups and downs in the real estate market over the years. We've taken that, coupled with our experiences during COVID, and we're helping put together some predictions for the future here in this episode. Unfortunately, I don't have a crystal ball, so we can't guarantee that some of these or all of these predictions are even going to come true, but these are what we're basing our future decision making on and what we hope will actually help you make some decisions as well. So we're going to break this down into a couple of different phases. First thing we're going to talk about is when COVID first struck. During COVID, when things first were getting started, there's a lot of worry and angst in the market, and sellers weren't understanding where the market was going to go, and there was a lot of panic selling, driving prices lower across the board. Now, this didn't happen a ton in Boston or some more stable markets like Boston, but we did see some of that happening here as well. For example, we were able to actually buy a beautiful brick building in South Boston for $1.5 million that ended up appraising for $2 million without any work being done to it. That's $500,000 in equity just for knowing the right time to buy. The work from home lifestyle contributed to an uptick in suburban buying and vacation rental markets across the United States, with cities such as Boston feeling most of the strain in their sales and rental market, where areas are more constrained and people didn't have the space to spread out and work from home. During the COVID-19 pandemic, we were in a worldwide recession. People were losing their jobs on a daily basis, trade was disrupted, materials were not being produced, and all of this led to uncertainty for the future. People didn't know where things were going to go, but now, fortunately, after all of that, we're on the upswing, which leads me to my next point. Post-mask mandate, when things started to get back to normal and we started coming out of that recession, we noticed that there was a huge buying boom as buyers who had sat on the sidelines afraid to get into the market returned to the market. As time went on, sellers who had also been sitting on the sidelines or holding onto their property also started joining the market in force. Since then, we've seen more of an equilibrium between buyers and sellers as more inventory has entered the market to meet the demand of those buyers. So in simple economic terms, when the supply in the market exceeds the demand, or we have more sellers than buyers, there's going to be further downward pressure on pricing because there's more inventory than people to buy it. Right now, although there is a lot of supply in the market, that downward pricing pressure is being counteracted by the inflation and also the high cost of building materials for new construction. Maybe you've heard about the crazy high lumber prices earlier this year. This is caused by lumber mills and factories pulling back production in anticipation of a lull in building during COVID. Unfortunately, the opposite happened as homeowners built decks and additions, and suburban markets added additional housing units to meet the demand. This additional demand, coupled with the low supply, caused lumber and other building materials to spike astronomically. This same trend has played out for most other building materials, not just lumber. Factories who laid off workers in anticipation of the lull in building and a decreased demand have had a hard time rehiring workforce in order to catch back up with the demand in the current market. Inflation and the additional cost to build new all contributes to upward pressure on the price of existing properties. The Delta variant, which is spreading like wildfire right now across the country, has the ability to potentially knock us out of this equilibrium that we're seeing and drive prices lower again, but the true impacts have yet to be seen. The rental market has been hot for young professionals rushing back to cities where employers are telling them that offices are going to reopen and they have to be back to work in those offices come September. Investors who did well in the stock market, from the deep trough of early COVID to the highs that we're seeing today, are dumping that money into investment real estate, such as rental property and commercial assets, driving up the prices of these properties and causing an increase across the board. Now, looking forward to the future, interest rates are expected to rise in the next couple of years from the lows that we're seeing right now, which is going to reduce the buying power for millions of consumers, thus putting further downward pressure on the market. Depending on how work from home policies shift from major employers in the United States, this will have a heavy impact on where housing demand actually settles, suburbs versus city. Traffic is expected to be worse than ever, as historically low numbers of people are using public transit and are choosing to drive instead. If jobs do settle in cities, this could make commute times even worse for people and shift housing demand back to city centers where people can be close to their jobs. We believe that actually what people value in their homes has also shifted. People are now putting further emphasis on having outdoor space, having separation of spaces, and having more space in general. So we're actually seeing a shift away from open concept to more segmented floor plans where multiple occupants can have separation from one another. So in summary, initially during COVID, we saw a decrease in buyer activity in the cities and an increase in the suburbs as people's lifestyles shifted to work from home. And then this past spring and summer, we saw a buying boom as people that sat on the sidelines previously, worried about the recession, worried about COVID, returned to the market as mask mandates were lifted. Supply has since caught up with that buying boom, which we would expect to have downward pressure on the pricing in the market. But inflation and the additional cost of building materials to build new are keeping pricing stable. Looking to the future, we expect demand for city centers to increase once again as jobs shift back to in-office work and traffic becomes more unbearable as people try to commute from their suburban purchases to their jobs in the city. So we're still bullish on buying in the city as long as those properties that we're building or renovating meet those values that we talked about previously: separation of space, more space, and outdoor space. We expect pricing largely to remain stable across the market and increase slightly as interest rates rise slowly and the cost of building materials starts to normalize. The two wildcards that could throw all of this out of whack are the Delta variant, which we're watching very closely, and the severity of inflation. So we're going to be monitoring the market as things progress and keeping an eye on these wildcards. If there's interest in this episode, we'll do a future episode on another market update for you. Thanks so much for joining us and McHugh Electric for another episode of Bring It On Real Estate. Don't forget to like, comment, and subscribe for more custom content like this, and we'll see you again real soon. Hey guys, Adam Burns here, and I'm with my lovely wife Shelby. Like all of you, she has lots of questions about real estate.
Yep.
We just got done watching the rough edit of our COVID episode, and I think that she has some questions for us.
I do, of course. So, two-part question.
Oh, two-parter.
Two-parter. First, we'll take it from an investment standpoint. So, given where things are right now, and with this Delta variant, and knowing, of course, where prices are, and we've kind of got I feel like, building pricing structure figured out for buying, building, etc. As an investor, what should I be doing right now, given where things are at, with the possibility of these variants leading us into what we went through last year? Basically, should I be buying something right now? Should I have something in the works and just continue to build? So do I buy and build, or do I hold off?
I feel like that was more than two parts.
Sorry.
Yeah.
We haven't even gotten to the second part yet.
Oh man. So I think what I'm hearing is, what do I do now as an investor in the current market?
Yeah.
That was essentially it, right?
Yep. What should I be doing?
I mentioned in the episode that we're bullish on still buying in the city.
Okay.
I would say that I would recommend the same to anybody else that's watching this, that buying in city centers is still a sound investment. We would advise that people still continue to buy because real estate is one of those things that it's always going to continue to trend upwards.
Yep.
It might be a little bit more slowly, and there might be some up and down fluctuation over time, but over the long term, real estate is still going to trend upwards. And we are still anticipating, even with the Delta variant, we're still looking in the direction that offices are opening this fall. People are going to be coming back to the city more and more, and traffic increasing is going to drive people back to city centers anyways.
Okay.
Building costs are another one of those factors that we're watching
Yep.
very, very closely. Things have come down and settled down a little bit, and they're continuing to trend in that direction. So I'd say right now, investing in the city is what we're doing and what we're recommending, and continuing to build and develop safe, suitable, and comfortable housing is still very much a possibility.
Okay. So what I'm hearing you say is it doesn't matter if I buy something that's already been built and I'm just looking to do a minor renovation, or if I buy something and build?
Yeah, so construction costs are going to have an impact on both of those options, whether
Right.
you're renovating or whether you're building new. I think that there's still a lot more forced appreciation in building something brand new, as we've talked about on other episodes.
Yep.
So I would say that in a market, in a time where things are more constrained, your profit margins are more constrained because the additional cost to build
Right.
and the additional cost to purchase, you should be going for the option that's going to create the most upside potential for you, which is either a deep renovation or new construction.
Yeah, I think I'm worried with new construction. If I were an investor, I'm worried about things shutting down again, potentially, and then having my project sit there half done, right? And then what if something happens where, the foundation, I didn't finish it and it gets washed away,
Yep.
right? Or what is left out? Is that a fear for you at all with some of your buildings that might not be finished?
No, so I don't believe that we're heading toward any further shutdowns.
Okay.
We have really robust COVID measures in place, hand washing stations, mask protocols and mandates. We can roll back to a lot of those COVID procedures that kept our people safe throughout the last year that they were operating on construction sites, even during some of the more difficult times of COVID.
Okay.
So I don't think that we're headed in that direction. We have all of these things in place that we can roll back to. And I would say to your second point, which was, I'm actually forgetting now, what was
The fear of things, stopping construction and things getting damaged if construction does stop.
Yep. So last time around, there were emergency protocols in place if you had something that would be negatively impacted or irreparably harmed by the shutdown,
Yeah.
that you were allowed special license to continue working on it, to get it
Oh,
to a
awesome.
point where there wouldn't be damage to your structure.
Oh, that's great to know.
So like if you had a roof off and you're worried about water damage to the inside, you would have special license to finish the roof.
Gotcha. Oh, that's awesome to know. Now the second part to the two-part question.
So those other three parts weren't
I
part of
guess,
the two
yeah, I guess we'll call it the fifth part. So as a potential homeowner, right? So let's switch away from the investor side. As a potential homeowner, you had mentioned that supply and demand seem to be pretty even right now. So knowing that supply and demand have kind of caught up to each other and interest rates might only continue to increase, is now a good time to buy?
Yeah, interest rates have actually reduced over the past couple weeks and are continuing to remain very low.
So I should buy now.
Yeah, it is a good time to buy now.
Yeah.
Things are relatively in equilibrium, so there's more conversation to be had between buyer and seller. So it's
Sure.
an opportunity as a buyer to have that open, candid conversation with a seller rather than multiple offers being thrown in, crazy bidding wars, waiving home inspections. Now is the time where you can actually have a calm buying experience and have
Okay.
a little bit more of that dialogue. And then to your point, yeah, interest rates are at an all-time low right now. I saw a refinance the other day at 1.85%. So now
Typical is standard.
there's no typical. I mean, it varies by
What's the highest you've seen?
time and decade and when it is in our economy. The highest, we saw a lot of rates for construction during the last peak of about 6%.
Okay. Just to put it in perspective.
Yeah,
So
and
2 to 6%. We're at the lower end right now.
Yeah, pretty much.
Okay, cool. Was there something else you were going to say?
No, I think that interest rates are at an all-time low, so now is a good time to buy.
Okay, and there's two markets that are really hot right now, speaking of buying, and I want to compare buying versus renting. So it seems like buying in the suburbs is still pretty hot, and then renting in the city is pretty hot, right? Because people don't know what's going to happen. I don't know if people are necessarily buying in the city. So which would you say is a more affordable option right now? Should I buy in the suburbs or should I rent in the city?
I think you should go back and watch our renting versus buying video and make a decision that makes sense for your lifestyle and your future goals after running that calculation to see if it's more cost effective for you to rent or more cost effective for you to own.
Taking, I'm sure, into consideration transportation, like where my office is located, etc.
Yeah, time out of your day to commute.
Yeah.
If you're coming from the suburbs, that's obviously a time savings. So you have to put a value on what your time is worth.
Yep.
So those things are certainly factors as well.
Awesome. Thanks.
So what else?
Okay, so as a landlord with prices kind of staying pretty consistent, right? They dropped, went back up. However, you have taxes, et cetera, increasing. Have you seen a decrease in the, I think it was capitalization rate or
Cap
gain?
rate, yeah, that we talked about before.
Yeah, have you seen a decrease in that in your current properties? You said usually you shoot for like 8 to 10%.
Yeah, so we haven't adjusted the margins that we're looking for in future properties because we're still able to achieve those things, adjusting for the additional expenses. But we have seen certainly our margins decrease on the existing properties that we own because inflation has caused cost of goods to increase. It's right now in Boston, we just went through a reassessing of all of our properties, so taxes have shot up. So those taxes increasing takes a big chunk out of what we're taking home every day. Increase in costs in general and pricing remaining stable from, call it 2018 to 2022, that's not good for us in our existing properties because as long as property rents are not increasing, we're not able to keep up with inflation and taxes and everything else that's contributing to additional costs. So I don't know the exact percentage that things have decreased, but over time, having owned these properties for a longer period of time, maybe we shot for 8 to 10% initially, but maybe they've gone up to, call it, a 12 cap or 12% capitalization rate over the time that we've owned it, and then maybe it's dropped back to that 8 to 10% that we were originally shooting for.
Gotcha. Awesome. Well, it seems like it's a good percentage to start at then for that reason because it gives you some cushion. You go up over the years, and then if something like COVID happens, now you can kind of drop back down to what that expectation is.
Yeah, always good to have that additional buffer built in.
Awesome. Well, thanks for taking the time to answer my questions. That's all I've got.
Thanks so much.